For thousands of years, gold has meant something. Not just financially, culturally, spiritually, historically. Every major civilization that has ever existed has placed enormous value on this soft yellow metal that you cannot eat, cannot burn for fuel, and cannot build anything structural with. The Egyptians buried their pharaohs in it. The Romans built their entire monetary system around it. Spanish conquistadors crossed oceans and destroyed civilizations chasing it. And today, in 2024, central banks around the world still hold hundreds of billions of dollars worth of it in vaults. There is something almost irrational about how deeply gold is woven into the human story. And yet here we are, doing a financial channel, and we have to ask the uncomfortable question. Is gold actually a good investment? Or is it just a shiny rock with 5,000 years of incredible marketing behind it? The answer is genuinely more complicated than either the gold bugs who think it is the only real money, or the gold skeptics who think it is a barbarous relic with no place in a modern portfolio. So today, we are going to go through all of it. The history, the performance, the real role gold plays, the ways to own it, and the honest framework for deciding whether it belongs in your financial life. Welcome to Better Investments. Let us start with what gold actually is as a financial asset, because it is fundamentally different from almost everything else we have talked about on this channel. When you buy a stock, you are buying ownership in a business that generates revenue, hires people, creates products, and ideally grows over time. When you buy a house, you get a physical asset that provides shelter, generates potential rental income, and sits in a local economy with supply and demand dynamics. When you buy gold, you get gold. That is it. Gold does not pay dividends. It does not generate earnings. It does not have a CEO trying to grow the business. It just sits there. And this is the core tension at the heart of the gold debate. Warren Buffett has probably said it most bluntly. He has pointed out that if you took all the gold in the world and melted it into a cube, it would be about 68 feet on each side. And then you could stare at it. That is all it does. It just sits there. It does not produce anything. Buffett has said he would rather own productive farmland or businesses than a giant cube of non-productive metal. And from a pure returns perspective, the data largely backs him up. Over the very long run, gold has not been a great wealth builder. From 1980 to 2005, gold was essentially flat in price, losing ground to inflation, while stocks compounded at extraordinary rates. If you had bought gold at its 1980 peak, you would have waited over 25 years just to get back to even in nominal terms, and far longer in real inflation-adjusted terms. The stock market over that same period turned every dollar into roughly $12. So case closed, gold is terrible, right? Not so fast. Because here is where the story gets more interesting and more honest. Gold has a specific job to do in a portfolio, and judging it by stock market return standards is like judging a fire extinguisher because it does not make good coffee. You are using the wrong metric. Gold is not trying to compound your wealth. Gold is trying to preserve it. Gold is trying to be there when everything else is falling apart. And at that job, it has an extraordinary track record. Think about 2008, the financial crisis. The S&P 500 lost about 37% of its value in a single year. The banking system was genuinely on the verge of collapse. People were terrified. Gold that year gained about 5%. Not spectacular. But when your stocks are down 37% and your gold is up 5%, that is an enormous gap in your portfolio outcomes. Think about the early 2000s after the dot-com bubble. From 2000 to 2002, the S&P 500 lost nearly half its value. Gold gained roughly 14% over that same period. Think about 2020. At the very onset of the pandemic, when markets were crashing in February and March, gold held its value far better than stocks. And from 2018 to 2020, gold returned about 60% total. These are not cherry-picked anomalies. They reveal something consistent and real about what gold does. In periods of genuine fear, genuine uncertainty, genuine systemic stress, gold tends to hold its value or go up, while other assets fall. This is why central banks hold it. This is why it has persisted as a store of value for millennia. Not because it compounds beautifully, but because when the world gets scary, it is one of the few things people universally agree still means something. So what drives the gold price? This is where a lot of people get confused. Gold prices are driven primarily by a few key forces. The first and probably most important is real interest rates. Real interest rates are just regular interest rates minus inflation. When real rates are high, meaning you can put your money in a savings account or government bonds and actually earn more than inflation is eating away, gold becomes less attractive because gold pays you nothing. Why hold something that earns zero when you can earn positive real returns in bonds? But when real rates are negative, meaning inflation is higher than the interest you can earn on safe assets, suddenly gold becomes much more attractive. You are not giving up meaningful returns by holding it because safe assets are already losing purchasing power. This is why gold surged in the early 2020s, when the Fed was keeping rates near zero while inflation ran hot. It is also why gold struggled in 2022 and early 2023, even as people expected it to shine during high inflation, because the Fed raised rates so aggressively that real rates went positive again, making bonds more competitive. The second driver is the dollar. Gold is priced in US dollars globally, so when the dollar weakens, gold tends to go up, and when the dollar strengthens, gold tends to come under pressure. The third driver is fear and uncertainty. Geopolitical instability, wars, banking crises, currency collapses. When people lose faith in institutions and financial systems, they run to gold because it is the one asset that has never gone to zero in 5,000 years of human history. No government has ever had to bail out gold. No CEO has ever committed fraud and destroyed the value of gold. It just persists. Now let us talk about the specific ways you can own gold, because they are not all equal and the differences matter. The most obvious way is physical gold. Coins, bars, bullion. You buy it, you hold it, you put it somewhere safe. There is something psychologically satisfying about this. You have a real, tangible thing in your hand that has value. The downsides are real though. Storage costs money. Insurance costs money. If you are holding meaningful amounts of gold at home, you have a security problem. And when you want to sell, you have to find a buyer, verify authenticity, potentially pay dealer spreads. Physical gold makes sense for people who want genuine off-grid insurance against systemic collapse scenarios, but it is not the most efficient investment vehicle. The second way is gold ETFs, exchange-traded funds. The most popular is GLD, which holds physical gold in a vault and sells shares that represent a fraction of that gold. Buying GLD is like buying gold without having to store it. You can buy and sell it on any brokerage in seconds, just like a stock. The expense ratio is around 0.4% a year, which is not nothing, but is reasonable for the convenience. There is also IAU, which has a slightly lower fee structure. For most investors who want gold exposure, ETFs are the cleanest, most practical way to get it. The third way is gold mining stocks. Companies like Newmont or Barrick Gold that dig gold out of the ground. Here is the thing about miners that surprises people. They are not the same as gold. Mining stocks are leveraged plays on gold. When gold goes up, miners often go up by more because their profit margins expand dramatically. But when gold goes down, miners often fall by more because their costs are relatively fixed and their margins get crushed. And miners carry all the regular business risks that come with running a company: operational problems, management issues, geopolitical risks in mining regions, debt problems. So if you buy miners thinking you are buying gold, you are actually buying something more volatile and more complicated. That is not necessarily bad, but you need to understand what you own. The fourth way is gold futures and options, contracts to buy or sell gold at a specific price at a specific future date. This is largely institutional territory and is not where retail investors should be playing around without serious expertise. Now let us talk about the current moment, because gold has been doing something remarkable that a lot of people have not been paying attention to. Gold hit all-time highs in 2024, surpassing $2,400 an ounce and continuing to push higher. This is happening in an environment where real interest rates are actually positive, which historically works against gold. So why is it going up? A few reasons. Central banks, especially from China, Russia, India, and other non-Western nations, have been buying gold aggressively. In the aftermath of the freezing of Russian foreign reserves following the Ukraine invasion, a lot of countries started thinking about what it means to hold dollars and dollar-denominated assets when geopolitical relationships can sour overnight. Gold cannot be sanctioned. Gold cannot be frozen by a foreign government. Gold held within your own borders is yours, no matter what happens politically. So there is a meaningful shift happening at the sovereign level in how countries think about gold as a reserve asset. Second, there is genuine concern in some quarters about long-term dollar credibility given US debt levels and deficit spending. Whether that concern is justified or overblown is a separate debate, but it is driving real demand. Third, geopolitical uncertainty is elevated across multiple theaters, and gold tends to respond to that. So the current gold rally is not irrational, even if the pace of it has surprised many analysts. Here is the honest framework for thinking about gold in your own financial life. 1. Gold is insurance, not an investment in the traditional sense. If you go into gold expecting it to compound like stocks, you will be disappointed over most long-time horizons. If you go into gold understanding that it is there to hold value when other things fall apart, you have the right mental model. 2. A small allocation makes diversification sense. Most financial advisors and portfolio managers who include gold at all suggest somewhere between 5 and 10% of a portfolio. Not zero, because the diversification benefit is real. Not 50%, because the long-term return drag is also real. The academic research on portfolio construction generally finds that a small gold allocation improves risk-adjusted returns, even if it slightly reduces overall returns in strong bull markets. 3. Physical gold versus ETFs depends on what you are actually worried about. If you are worried about a moderate economic downturn or inflation spike, a gold ETF is perfectly fine. If you are worried about genuine systemic collapse, where financial systems themselves stop functioning, you might want some physical gold, because a digital representation of gold is only as good as the institution holding it. Most people are in the first camp, and ETFs are sufficient. 4. Do not buy gold because you are scared. Panic buying at the top of a fear-driven rally is how people get hurt. If you want gold in your portfolio, add it methodically as part of a plan, not reactively because something bad happened and gold is spiking on the news. 5. Understand that gold in dollars is not the whole picture. Gold tends to preserve purchasing power over very long time horizons. An ounce of gold in ancient Rome could buy a fine toga and sandals. An ounce of gold today can buy a fine suit and shoes. That is remarkable stability over 2,000 years. But that is preservation, not growth. If your goal is to build wealth, gold is a complement to a growth strategy, not a replacement for one. Here is the bottom line on gold. It is real. Its role as a store of value is real. Its function as portfolio insurance during crises is real. The emotional and psychological value of holding something with 5,000 years of universal agreement behind it is real. But it is not a compounding machine. It is not going to turn a small amount into a large amount over decades the way equities can. The ideal use of gold is as a stabilizer, a diversifier, and a hedge against the scenarios where everything else is going wrong. A small, thoughtful allocation that you buy and hold and largely forget about. Not a speculation, not a panic trade, not a doomsday bet. Just a quiet piece of a balanced portfolio doing the job it has always done, which is surviving everything. Next time on Better Investments, we are going to talk about cryptocurrency. Bitcoin, Ethereum, all of it. The most divisive, most volatile, most misunderstood asset class of the last 15 years. Is it the future of money, or is it the greatest speculative bubble in human history? That is a genuinely hard question, and we are going to answer it as honestly as we can. Subscribe so you do not miss it. And if this video changed how you think about gold, share it with someone who has been told to buy it or avoid it without ever really understanding why. I will see you next time.